Let's now talk about the Federal Reserve, inflation, what's going to happen tomorrow, and what Goldman Sachs is projecting. This is a pretty interesting piece we're going to be going through from Goldman Sachs. But first, Canadian inflation, kind of interesting. Big drop compared to the estimates. Canadian CPI year over year for February came in at 5.2 versus the 5.9 previous and the estimate of 5.4. So a nice softening. We want to see that in the international community, just like we want to see that at home. It looks like we had month over month come in at 0.4 versus the 0.5 previous and 0.5 estimate. Now, some are arguing that we're going to be crossing base effects, which is where we compare to high levels of inflation last year, and that's why we could potentially be getting staggered down inflation reads going forward. But look, I don't care what it is that's pushing inflation down. I'd like to see inflation trend down because it's going to help us convince the Federal Reserve to do what? Of course, to pause. So let's talk about the Goldman Sachs projection for tomorrow. This came out yesterday, and this is the forecast from Goldman Sachs. I was reading this last night, and this is the forecast from Goldman Sachs. They are calling for a Federal Reserve pause tomorrow. Tomorrow is also coupon expiration day, guaranteed best price. Prices will be going up after that for those great programs on Building Your Wealth link down below. 0 to mill and stocks and psych most popular right now. So what do we got? We expect the Fed to pause at its March meeting this week because of stress in the banking system. Now, that's interesting. A lot of folks are saying the stress in the banking system is exactly why the Fed would pause, and that makes logical sense. However, I personally, and this is my take, I'm of the mindset that the Fed doesn't actually think that rates would really affect solving issues at the banking sector. In other words, is a pause really going to change anything for the banking sector? Let's put it this way. Remember what affects banks right now. What affects banks? Well, what affects banks are the value of treasuries. Now, yes, the Fed action could drive the value of treasuries, mortgage-backed securities, agency securities, whatever. All of these could be affected by the Fed's decision tomorrow, yes, but they could probably have a similar effect with their talking. In other words, I don't think the base FOMC rate is going to be really necessary for the Fed to try to manipulate the banking sector at all. I think they can do that with their talking, their yapping, and their projections. So I actually think the Fed is going to go for, we need to maintain the inflation fight. We do that with rates. Banking, we solve with the by the Fed pivot facility. There we go. By the Fed pivot facility. That's not actually what it's called, but that's what we nickname it. By the Fed pivot facility. That's how they solve banking. So that's my take as to what they're going to say tomorrow. And really, Treasury yields have come down so much that the value of a lot of this agency debt has actually gone up. Because remember, let me rephrase this. When Treasury yields fall, the value of the bonds goes up. One of the big issues that you've had at the banks is this plummeting in the value of their bond portfolio. They're held to maturities and they're available for sale securities. Well, both of them have been plummeting in value, and as people take money out of the banks, they have to sell something that's worth less money now. So in other words, the banks are like, crap, we're losing asset value while being forced to basically liquidate. This sucks. But because the banking crisis started, we've actually seen Treasury yields plummet, bond values rise, which actually reduces some of the strain on banks. So in other words, you could be in a situation where the Fed looks and says, look, things are getting better. The banks saw the value of their bonds rally. Financial conditions are still tight, even though bonds rallied and yields fell a little bit. We've got an inflation fight to worry about, and that's the top priority for us because there's nothing worse than losing control of inflation. I really expect the Fed to say that. Now, of course, I want to go through the Goldman Sachs argument here, but just to finish, I suppose, my own, take a look at this right here. These are and it's straight up from Goldman Sachs Financial Conditions Index. Where are we as of this morning? Still stable and high, much higher than where we were in January. And Jerome Powell was satisfied with that bump right there. That's a crazy thing to think about for a moment. When that hot jobs report came out in January, Jerome Powell was like, oh, well, financial conditions have already tightened. He basically rolled it off the cuff to say, well, financial conditions are tight. We're Gucci. That was down here. We're up here. So things are actually tighter now. Then over here, this is the 5-year break-even inflation rate. This is, in my opinion, what right here is going to reiterate the Fed going for 25 tomorrow. The 5-year break-even rate on inflation ticked up again into this morning here, last night into this morning. That, to me, is telling the Fed, okay, we got to stay strong, because if we lose control of inflation expectations, then we're really screwed, and we don't like getting screwed. Here's that inversion of the yield curve. This is the 10-2 we're looking at. Obviously, the steepening is usually a sign of something breaking, which is exactly what happened. But let's that's my argument, right? But let's now that I've poisoned the well, I suppose, let's go into the Goldman argument. So they say that the Fed should take a pause in the inflation fight. But that should not be a problem, because bringing inflation back to 2% is a medium-term goal, says Goldman Sachs. So in other words, we have time, which the FOMC expects to solve only gradually over the next 2 years. I don't know where they're getting this 2-year idea from. That seems a little wild to me, because the Federal Reserve in the past has taken the approach of opportunistic disinflation, which is where they've literally waited 20 years to get down to 2%, but whatever. The inflation problem actually looks less urgent now than last summer. Again, I personally disagree with that, because if the Fed loses control of expectations, then we're really screwed. But anyway, and that's because near-term expectations have fallen sharply. That is true. Long-term expectations for inflation remain anchored. True. Moreover, the link between a single 25 BP rate hike and future inflation is very tenuous. That's also true. How much is a 25 BP hike really going to make a difference? But you could say that same thing in both directions, right? You could say, hey, what's the difference between 25 BP as a hike? It's not going to hurt anything. Just like you could say, hey, why another 25? Is it really going to help? You could go in both ways with this, right? Now, I see your comments here. Somebody says, banks need cuts to survive. Well, not necessarily. In fact, banks, what they need is the value of their bond portfolios to go up. The value of their bond portfolios just skyrocketed through the banking crisis. Now, yes, I understand it skyrocketed from a hole, right? It's like it plummeted and then it's up. It's like that meme that we see where everything plummets and then it goes up a little and we're like really happy. That did happen. Now, of course, even Elon Musk is chiming in on this, which this is generally a negative indicator, in my opinion, for Tesla when he yaps like this, which is okay. This is not to say that Elon shouldn't. I'll take it. It's actually just a little bit of a leading indicator. When he starts complaining about rates, it's a sign that maybe auto loans are getting a little tougher to manage. But take a look at this. So this right here is Twitter. Bill Ackman says the Federal Reserve should pause on Wednesday. We have had a number of major shocks to the system. 3 bank closures in a week, wiping out equity and bondholders. The demise of Credit Suisse and the zeroing of its junior bondholders, notably bondholders bearing losses, is a major problem. Notably bondholders, okay, it's a major phenomenon. Fine, whatever. So then he talks a little bit more here about First Republic and the effect about this meaningful tightening that we've seen is not yet visible, fully visible. He's basically talking about the lags of rate hikes here. Now, Bill Ackman is convinced the Federal Reserve studies his tweets. So he takes, in my opinion, he puts on this sort of like God complex and is like, Fed, you must listen to me. We don't yet know where all the losses are. What if there are more failures of other banks, which honestly there probably will be. There are too many lag effects, and yes, inflation is still a problem, but Powell can do that by pausing and making it very clear that this is a temporary pause. No, it's not going to happen. It's absolutely not going to happen. And I'll tell you my opinion as to why. And I'll take the L. I'll die on the hill if I'm wrong. It's fine. But I'm going to make the argument here, okay? Anyway, Elon replies to this and says, no, we don't need a pause. We need to drop the rate by 50 BP on Wednesday. It's not going to happen either. And I'll explain why. So here's the thing. The Federal Reserve, for the last year, has said we need to prevent the mistakes of the 1970s because in the 1970s under Arthur Burns, we had a start-stop mentality at the Federal Reserve, which was this idea that, okay, things are getting better. Let's pause. Okay, inflation's coming back. Okay, let's hike again. Okay, it's calming down again. Okay, let's pause. That created Paul Volcker. That is literally what Jerome Powell wants to prevent. Even though people say Jerome Powell wants to be a Paul Volcker and that he's a wannabe Paul Volcker. I actually don't think he wants to be a Paul Volcker. Because here's the thing. Let's put the bias hat on for a moment. If you're Jerome Powell, what do you want? I will make it crystal clear what you want if you're Jerome Powell. Inflation to go to 2% with as little job loss and damage to the economy as possible, and ideally no recession. Simple, right? He doesn't need to Paul Volcker us if inflation goes away, because Paul Volcker is the equivalent of pain. And Jerome Powell himself said, we don't want to cause unnecessary human pain. Even though in the past he said we could always over-tighten because then we could always basically turn the money printer on again. He's balanced that argument now with the idea that he wants to limit human pain. Now, Arthur Burns in the 70s took this start-stop approach. And since then, the Federal Reserve has made it very clear that was stupid. Now, in fairness, they didn't know because they didn't have another situation like that to compare back to. But today we do. And today the Federal Reserve has made it very clear that a start-stop approach is a very bad idea because it potentially unanchors inflation expectations, and then you're really screwed. Now you have Bill Ackman, Elon Musk, and Goldman Sachs all calling for either a pause or a cut. But a start-stop is exactly what the Federal Reserve has telegraphed they will not do. They have telegraphed a start-stop approach is not happening as clearly as I have reminded you that there's a coupon code expiring tomorrow, that you can get life insurance in as little as 5 minutes. It's exactly what I use, Apple Pay and Android Pay for, link down below. And you can get 12 free stocks with Webull by going to mettkevin.com/free. All of those are linked down below. Like, as clearly as I've telegraphed those pitches, the Federal Reserve has said we are not going back to start-stop. It seems crystal clear, but then again, people still have their hopes. Again, this is all, I'm saying this, 16 hours before the event. So maybe I'll take the L here, and I'll gladly take the L, but I think we're getting 25 and no start stopping. I think Jay Powell goes, look, financial conditions are good. We'll keep rates up to keep fighting inflation. And on top of that, the value of agency securities that banks hold has just gone up. So that should actually take some stress out of the system, along with our Buy the Fed pivot facility. Anyway, Goldman Sachs goes on to say that tighter lending standards resulting from bank stress will subtract about 0.25% to 1.5% from GDP growth in 2023, the equivalent of an impact of another 25 to 50 BP of tightening on financial conditions. That's their belief. I actually think that could be a little greater, but that's okay. The estimated impact is relatively moderate in part because lending standards had already tightened sharply in prior quarters. They're basically throwing cold water on the idea that why do we need another 25 BP? Okay. However, the risks are tilted toward a larger effect, and the uncertainty will likely linger for a while. Yes, uncertainty will likely linger for a while. This is true. Let me just be clear. If we get a pause tomorrow, I personally think we're going to the moon in the stonk market. I've said it before, I'll say it again. I think QQQ could potentially run up to 330. I think you could get the SPY easily run up past 410. And I think BTC could honestly start knocking on the door of 32K again. I potentially even higher. Would not surprise me at all if we get a pause tomorrow. I really don't think the market's actually expecting a pause. But anyway, we have left our Fed forecast unchanged beyond March and continue to expect. See, this is stupid, man. 3 additional 25 BP hikes in May, June, and July, which would raise the future peak to 5.25 to 5. Like, markets aren't even projecting that right now. And it's fine. I mean, it's Goldman's opinion, but it just seems like a very bizarre argument to pause and then go back to this idea of multiple rate hikes. I don't see it, but okay. Let's see what other arguments they have here. So expectations for the FOMC meeting have changed abruptly over the last 10 days. We now expect the Fed to pause. Banking stress calls for a pause. We discussed it in thinking, we discussed our thinking in our call. Our rationale is simple. It doesn't make sense to tighten monetary policy amidst stress in the banking system that could present substantial downside risk to the economy. Another thing that people have argued is that the banking crisis was really a tool to determine, okay, like we broke things, how bad is it going to get? And the Fed could actually potentially guide, are we going to go for 25 BP or not, based on what the market's reaction is. Well, the market's reaction is something that we could actually take a look at this morning, which is a benefit that Goldman here doesn't have. Take a look at this. If we hop on over here, look at this. First Republic up 25% in the pre-market, 26% now in the pre-market. Just go to the 5-minute chart here. So you can see First Republic recovering. UBS is running up 7% here. And Credit Suisse is sitting at 97 cents. That's almost 15 cents above the buyout price for this stock. So that arbitrage opportunity is continuing here, but it's showing you that people think there's a chance now that mortgage bonds and treasury bonds have actually increased in value. Maybe the pain is slowly over. Now, that's not to say there won't be other stresses on the regional banking system, but you just had Janet Yellen yesterday talk about how they're finding ways to potentially relieve the FDIC coverage limits and increase them to temporarily and potentially guarantee deposits of everyone at small and medium banks going forward, even without congressional authority. That's something that they're, quote, studying right now. But based on what the market is doing today, the market seems to think, oh, banking crisis? Yeah, okay, there might still be some strains, but this is not systemic. Anyway, we'll keep going back to this Goldman piece here. I remember I like looking at what other people, what the opinions of others are, because I do think it's very valuable to always challenge your own beliefs and opinions. All right, so as a result, additional stress in the banking system is the most immediate concern, but the lingering concern is that wealthy individuals and large depositors who are not fully protected might move away from the small banks. And this is what we've also talked about with basically this idea that maybe medium and small banks will get their FDIC limits extended. Of course, we've seen some substantially large borrowing. But why do they call for a pause? Well, they actually call for a pause because they argue here that inflation can wait 6 weeks. That the inflation problem looks less urgent now than it did last summer because of year-ahead expectations. However, you have to remember how the Fed looks at this. The Fed looks at this and says, that's fantastic that expectations are lower a year ahead for inflation, but we actually have to see those come through. We actually have to see those expectations come to fruition in reality. Otherwise, we could potentially risk those things not actually happening. You know, I know everybody's talking about this idea of housing disinflation, that owners' equivalent rents are going to tank. But what if they don't? That's a real possibility. Now, what if they don't? Well, if they don't, then you don't get the disinflation that you're projecting, right? So you actually do have to tighten to the point where you actually start seeing this stuff go through. Yes, that creates a risk of over-tightening. Our best guess is the economy will emerge strong enough that future rate hikes will be appropriate. That is from this banking crisis. Before the appearance of stress in the banking system, 2 trends in data suggested the risks lay in the hawkish direction. First, inflation news had deteriorated a little bit with upward revisions and further problems with the auto sector. Still have supply chain issues in the auto sector leading to increasing wholesale prices, not necessarily retail prices though. Second, strength in hiring. I'd like to see their data on strength in hiring. I question that a little bit. Real disposable income, which is still negative, and consumer spending all pointing to some risk of a moderate GDP reacceleration. Maybe. We'll see for January. But it's an interesting piece from Goldman Sachs. It's an interesting argument. There is an argument to be made about this idea of potentially pausing. I don't think it's a very strong one. The Fed's path beyond the March meeting will depend on the impact of the bank stress on the economy. So this is where they think the Fed could basically pause and then just re-tighten again 3 times. I really think that mirrors the 70s too much. And if that were to happen, you really got to start asking yourself, is the Fed just making a historically bad mistake? I think it would be wild. And the other thing that this would accomplish, a pause over here, is the potential fear, right? I mean, think about this. A Fed pause could easily be seen as, what do you know that we don't? And it's bad, isn't it? That's my thesis. I know that's a little bit jaded to think, but think about it. If we get a pause tomorrow, on one hand, it seems like, oh, that should be good, right? But then that's also going to get counterbalanced with fear. Sure, maybe we could rally under the idea of a pause, but wait a minute. What if the fear of a pause actually ends up extending too much? Where now all of a sudden people are convinced that the Fed sees how bad things really have gotten, and it's way worse than we think. It's not just Credit Suisse and Silicon Valley Bank and some of these crypto-related firms like Silvergate or Signature. It's potentially all banks. I mean, think about the banks that have collapsed. Credit Suisse has historically had horrible risk management procedures. Silicon Valley Bank lent to very risky startups who ran out of capital and, really in a recession are the least likely to survive. Then you've got Silvergate and Signature, who were basically a crypto on-ramp, but because of crypto's fall over the last year, you've had a substantial withdrawal of cash from these banks. Now, all of these banks that have failed so far have had higher risk profiles than most other banks. So if the Fed pauses after those failures, it's saying, oh no, those risk profiles extend to the regular banking system as well. That seems like a stretch for me to see the Fed doing that. I know a lot of people are calling for it, and this idea of a pause tomorrow. But I mean, we should make a bet. We should, you know what? Let's run a poll, and let's see what you think. Will the Fed pause tomorrow? All right, poll. Start your poll. Will the Fed pause tomorrow? Yes, pause. No, pause. We'll see what y'all think. Anyway, all right. Oh, yeah. So my take, actually, for what is going to be the most bullish for the market tomorrow. Well, let me answer that first, and then I'll talk about this section here from Goldman. So what would be the most bullish tomorrow? In my opinion, the expiration of the coupon code. But beyond that, I would say the most bullish thing would be a 25 BP and then a very dovish SEP and a dovish presser. And an optimistic view on inflation. That's what I think would be very, very good for the stock market tomorrow. Like, if we get this, I'm going to be very happy tomorrow. 25 BP, dovish projections on how bad things are going to get for, recessionary point of view, which will lead to a lower terminal rate and potentially a softer view on inflation. That's a hope. We'll see. That, in my opinion, this would be the best case scenario, in my opinion. Best case scenario number one. Best case scenario number two, okay, best case scenario number two would be pause along with a dovish SEP, dovish, let's see, presser. Not pressure. Presser is the press conference. And then optimistic view on inflation. This has the potential of creating some fear, but if it's matched with dovishness, that would be very good. Then you do have the bearish scenario. A bearish, I'll call this the worst case one. Worst case one would be 25 BP, hawkish inflation, a hawkish SEP, higher term, lower GDP, and hawkish press. That would be your probably more worst case scenario over here. I suppose you could also suggest there's a worst case scenario where the Fed pauses and then is hawkish. I think that would be unlikely. If they're going to hawk, it'll be 25. So I'll say these are the three scenarios. I'm going to go ahead and say that you're probably 50%, 30%. No. Let's go a little lower here. Let's go 20% here, and then maybe 30% over here. Those are Kevin's theses here. All right. March meeting. Whether the FOMC pauses or not this week, it's likely to include some acknowledgement about uncertainty. Well, no duh. I mean, this is like saying the sky is blue. We expect a few changes to the SEP. First, GDP growth will likely be revised up to reflect the strength of the first quarter. Maybe, okay. But what about the 2024 GDP? Second, the 2023 unemployment will probably be revised down, potentially by a 0.5 percentage points, revised down for this year to reflect continued strength. Okay, potentially. That's going, staying in the 3% range. Okay. Unemployment path for 24-25 will only come down slightly. They really think things are good, which, that's also somewhat bullish, right? Goldman to some extent here is saying, like, the economy's doing really well. Like, so what? Maybe a quick little pause to get through the banking crisis, and we'll take it from there. So these are their expectations. So they are they're going to increase their real GDP outlook compared to the Fed's right here. The Fed's in green right here. And let's see where their differences are. So their differences are higher GDP, lower unemployment, and slightly higher inflation, but not much higher, with a slightly higher terminal rate, 5.32. Okay, it's an idea. I'm really hoping that they lower that terminal rate. That's my thesis. In the video that I did yesterday where we covered my sort of thoughts on the SEP, I really think that term rate will come down. But maybe not. These were my projections. Let's see here. My projections were right here. So let's see here. This would be... Is this the right... Yeah, this is December. And I'm trying to remember what we talked about yesterday. The 4.25, we're past that. So 5.1. I remember what I said yesterday. I said I think 2023 is going to go to more like 4.8. So let me write that down. So 2023 would be more like 4.8. Was my take. Goldman thinks they're going to go to about 5.3. So they're going to pop this up a little bit. That's Goldman's take compared to mine. We'll see. We shall see. That's very interesting. But let's go ahead and see now what y'all voted here in the poll. So after all that, 22% of you voted for pause. 78% of you voted for no pause by JPOW. Doesn't this all seem manufactured? Trying to institute a CBDC. I don't know why people are so afraid about this idea of a central bank digital currency. DeSantis was freaking out about that yesterday. And he's like, if I become, he didn't say if I become president, but we all know what he means. He's basically talking about how he wants to get rid of or ban the ability of the government to have a central bank digital currency. I actually think that's fantastic for blockchain. I think a central bank digital currency is a choice and shows you, it gives you a lot of merit and credence to blockchain. I don't know why people are so afraid of this idea of maybe like a Fed coin or something like that. By the way, check this out. I got a house hack vest. Yeah, some nice colors over here. If the Fed pauses, the consequences could be horrific. All right. So the cure for a full banking system failure is a partial banking system failure? No. I think that in capitalism, when you go into a recessionary period of time, the riskiest businesses go bankrupt. That's the point. That's what capitalism is supposed to do. With a CBDC, they can control where you spend your money, when you can spend your money. They can apply negative interest rates and force you to spend your money. Privacy gone. You already have very limited privacy with a lot of cryptocurrency. Once people know what your wallet address is, you actually have even less privacy, right? And all it takes is the IRS to start mandating that you give them your wallet addresses, and there goes all your privacy. So the privacy takeover could happen regardless, right? This idea that they can control your money, that's no different from the fact that they can control your money right now at JP Morgan. JP Morgan can freeze your bank accounts tomorrow, and you have no control of your money. They can close your credit lines. They can close your credit cards. Like all of these things, the negative interest rate, all of those things can already happen in the central banking system. The idea that somehow CBDCs are like so much horribly different than what the banking system can already do with you. And don't get me wrong, like I think a decentralized alternative to the banking system has a lot of merit. I'm just saying, the idea that the banks can do all these things to you are ideas that already exist. So we'll see. Can't close my safe with gold and silver. Yeah, you got me there. That's true. Unless you put it in a safety deposit box, then they got you.